This is Ruta FX, and then as you all know, um, this is where we teach how to trade, and then we trade with beginner traders every blessed day. There is one thing that I want to talk about today in this live. So if you join this live, make sure that you subscribe and share. And then if you have any questions, to just put it at the comment section. This is IFS, and then as you all know, um, this is where we teach how to trade, and then we trade with beginner traders every blessed day. There is one thing that I want to talk about in this life. So if you join this live, and then if you have any questions, just put it at the comment section. This life is about how to build a strategy in forex trading. How to build a strategy in forex trading. Before you can become a successful trader, you should have a strategy that works for you. And how do you build that strategy? How do you get that strategy? So that is why we are doing this live today. So I will give you a very simple steps that will help you to build your own strategy that is going to work for you. So first of all, I will start by um, talking about market structure. You cannot have a workable strategy without understanding market structure. So when you market structure in the market, you should understand the language that the market is teaching you, that the market is presenting to you. Once you understand the language, and that's having a strategy is very simple. So first of all, you must understand the market structure. You must understand market structure. So when you open your chart, you ask yourself, what kind of structure are you seeing? Are you seeing a bullish market? Are you seeing a bearish market? Are you seeing a ranging market or a choppy market? So based on the kind of market structure that you see at that particular time you open the chart, gives you an information about what you should do in the next step. Okay, so first of all, understand market structure. Understand that we have three main types of market structure. We have a bullish, we have a trending market, a ranging market, and a choppy market. So if the market is not trending, then the market is ranging. If the market is not ranging, then the market is doing what? It's choppy. Gives you an information about you as a trader. You avoid and don't trade. Okay. So anytime you open the market and you realize that the market is choppy. When you say choppy market, it means that the market is moving haphazardly. So the market does not have a clear direction. So it goes up, goes down, goes up, goes down. Haphazard movement of the market is called choppy market. It does not have a clear direction. Okay, so a choppy market we do trading. The next one is a ranging market. When the market is ranging, that's support. Then we say that the market is ranging. So you realize that if the market, let's say we are trading gold, and then the market is ranging between 5,000 and let's say 4,000. So anytime it hit 5,000, then the market then the market res, move down. Once it hits 4,000, then it's create a support and then move up again. Hit 5,000 again, create a resistance, and then start sinking down to 4,000. That is a ranging market. So the market is moving in between a well-defined market um, price. Let's say 5,000 and 4,000. It hits 5,000, create a resistance, then move down, hit 4,000, create a support, move up again. So that is a ranging market. So when you realize that, oh, this market is ranging, trading it becomes very simple. You place your horizontal line just at the tip of the 5,000 where the resistance is created. Then you wait patiently that the next time the market hits 5,000 again and you see as a resistance created. How do you see resistance created? Maybe you will see a bearish harami pattern formed, or you see a bearish abandoned baby. Once you see a bearish abandoned baby, or you see a bearish engulfing candlestick form, or you see an evening star pattern, once you see all these things, that means that the market is creating some sort of support at that particular market level. So market creating a resistance market creating a resistance at that level, how do you confirm it? You confirm it by the pattern that is being formed at that point. Okay, the pattern that is being formed at that particular market price. So any of the bearish confirmatory patterns is enough for you to enter the market. So ranging market is one of the best you can trade as a trader. Then the next one is trending market. We have two types, an uptrending market and then a downtrending market. So if it's a downtrending market, how do you trade downtrending market? If it's an uptrending market, how do you trade it? Please, if you join, make sure you like and share. Okay, once you join the live, like and share. If only you want to be a professional forex trader, then you are with Ruta FX. Make sure you like. So if the market is in an uptrend, how do you know? It begins to make a higher high formation, a higher high formation. So once the market starts making a higher high formation, then you know that now this market is in an uptrend. And if it's an uptrend, what do? You wait patiently, mark your levels. So once you mark your level, you wait for pullback. Market comes, retests the previous low, and then once it creates a support, then you buy. It's as simple as that. That makes trading as easy and simple as that. So if the market is in a downtrend, it begins to make a lower low formation, a lower low formation. And once the market is making a lower low formation, what do? You sell. You look for sell opportunity. You wait for pullbacks, pull back, then you sell. Pull back, then you sell. Pull back, then you sell. Okay, so that is the best way of first of all having a strategy. So after understanding market structure, meaning that you understand the language of the market now. So once you understand market structure, what again? The next thing you should know is that entry confirmations. So you know that you've opened your chart and you realize the market is in an uptrend. If the market is in an uptrend, then what next? What next? You must master what you call entry confirmations. Entry confirmations. If the market is in an uptrend, you will be looking for a bullish confirmations alone. An example of a bullish confirmation is bullish harami pattern, a morning star, a hammer candle, um, a bullish abandoned baby. All these patterns are bullish confirmatory or confirmations. So once you see them, then you enter the market. So if you've not seen any bullish confirmation, there is no need for you to enter the market. So you should see bullish confirmation. So make sure you master what we call a bullish harami pattern, a bullish abandoned baby, a morning star, morning star, a bullish engulfing candle. Master all this. Okay, once you master them, those ones are your confirmations. So I said before you can have a good strategy, you must understand one, market structure. Two, you must understand confirmations or market confirmations or entry confirmations. Okay, and the confirmations that I'm talking about, if your market is an uptrend, you look for what? A bullish confirmations. And a bullish confirmation, an example is a bullish engulfing candle, a bullish harami pattern, a bullish abandoned baby, a morning star. Okay, these ones, and we also have a marubozu, a bullish marubozu pattern, or a bullish marubozu candle. A bullish marubozu candle is one of the strongest candle you can ever trade on the forex market. Very, very strong, but it doesn't form often. Once in a blue moon, then you see a marubozu candlestick forming once in a while. Okay, so make sure that you master your confirmations. The next one is a bearish confirmation. A bearish confirmation, an example is a bearish harami, an inverse hammer, evening star, bearish engulfing, bearish harami pattern. All these patterns are confirmatory patterns. Once you master them well, then you will know it's time for you to enter or it's not time for you to enter a trade. So master confirmatory patterns. The next one is you have to master how to place a stop loss. Yes, you know, mastering how to place a stop loss is one of the biggest game changer. Why? Because you cannot use a random stop loss. You must know your account size. You must know how much you are willing to risk on the market. And by so doing, you know how much stop loss you place on the market. So stop loss or placement is very, very important. Very, very, very important. You should be able to master a stop loss placement. Okay. Okay, so the next one is take profit strategy. Now, if you can master how to place a stop loss, then you should also master how to place a TP or a take profit. Okay, so how do you place take profits? You place your take profit usually if you are, let's say you are risking $5 per trade. Okay, if you are risking $5 per trade, then you'll be looking at um 1:3, 1:4, maximum 1:5. So if your risk is $5, meaning that if the market goes in your opposite direction, you're going to lose $5. Then you should be targeting three times of that $5. So you should be targeting making a $15 per on that trade, or a $20 on that trade, or maximum $25 on that trade. So if you are risking $5, then you should be targeting $15 profits, or a $20 profit, or $25 profit maximum. So maximum 1:5. So 1:2 raised to reward, 1:3 raised to reward, 1:3 4 raised to reward, and then 1:5 risk to reward maximum. If you are rating $100, then you should be targeting either a $30, 40 or $50 profits. Okay, that is the easiest way of placing your your TP. Now, and you must understand what we call liquidity. Okay, before you enter your market, know where a lot of people are interested in entering the market. Okay, that is where liquidity is being curated. That is where the money is. Okay, so once you know where or the interest of the big banks, okay, where the big banks or where the international banks are willing to enter the market, that is where you should also be interested in. Okay, so always make sure that you enter your market right after a liquidity sweep. Okay, all right. So up to this point, if you have any question, just put it at the comment section and then I'll answer you. I'll answer you once you have any question. Just put it at the comment section. If you've not shared yet or if you don't like, kindly like and share. Okay. If you have any question, just put it at the comment section and I'll answer you. So if you want to have a strategy in forex trading, first of all, understand market structure. And under market structure, we have three types: trending markets, ranging markets, and then a choppy market. Understand them. And also know what liquidity is and where liquidity is always located on the chart. Always you should be able to identify a price of liquidity. And then order flow, order flow, order flow. Make sure you master order flow. Okay, so explain lot size and leverage. Okay, so I will explain that. Lot size and leverage, I will do that. Okay, so order flow. Order flow, we usually use um, candlestick patterns to determine order flow. Usually, and if the markets or if you open your market and you realize that maybe in about 2 hours back, the market makes a huge movement into a certain direction, being an uptrend or a downtrend, and the candle that was formed was so huge, was so a big candlestick were formed. Then go and mark 50% of that candlestick, okay, or the middle of that candlestick, mark it there, and then mark the the point where that particular candlestick formed, mark that point as well. Okay, so order flow, meaning that if a huge bullish candlestick was formed, okay, then it means that the order flow is an uptrend, or the market or the interest of many traders is up, is to buy that particular currency. Okay, so you mark 50% of that particular candlestick, then you wait patiently. Once the market hits around that 50% and then it creates a support, that is a confirmatory for an entry. Or the market will want to retrace down to where that particular candlestick formed. And once it formed, it's retest that zone and it forms a support at that point, you are done. How do you identify markets creating a support? One, once the market hits at your level of interest and you see a bullish engulfing, that is a support created. Anytime a bullish engulfing candlestick forms, a support is being created. Anytime you see a morning star forming, there is a support created. Anytime you see a bullish harami pattern form at a level, that is a support created. Anytime you see a bullish abandoned baby form, you see, you must master these things. That is the only way you become profitable. Okay, so I'm going to explain what lot size is. When you say lot size determine your position size. Okay, so lot size is um, directly proportional to position size. How much you can buy or how much you can sell. So for example, if you have we have three type of lot size. Let me explain that. We have three types of lot size. Lot size is being divided into three types. We have a standard lot size, a mini lot size, and then a micro lot size. So depending on your account will determine which of these lot size you should use. Okay, so for example, you can only use standard lot size if your account size is huge. Let's say you have 10,000 USD account, then you can use a standard lot size. The reason why you can use standard lot size in 10,000 USD account is that, in a standard lot size, just 1 unit of a currency pair is um is sorry, in one standard lot size is equal to about 100,000 unit of currency pair. So what we are trying to say is that if you have one standard lot size and then the market makes one pip, I hope you all know pip. So if the market make one pip and then you are using a standard lot size, you make what? $10. So in a standard lot size, one pip is equal to what? $10. One pip is equal to what? $10. So for example, if you have gold, let's say gold, the market price of gold is, let's say, 5,000.123. Now, if the market change from 5,000.123 to 124, that is one pip. One pip movement, meaning that the market has moved to an upside one pip. So that one pip means that in a standard lot size, that one pip, if you are using a standard lot size of, let's say, 1, and the market move just that one pip, you're going to make what? $10. Do you understand? So your lot size determines your trading power, your trading ability, and it determines how much you can make, how much you can lose, or how frequent you're going to make your profit and how frequent you're going to lose. Okay, so in a standard lot size, one pip or one standard lot size is equal to what? $10, or is equal to what? Um, $10 per pip. So just one pip movement, you make $10. You see how interesting this is. So knowing or understanding this makes trading easy. If you are using a standard lot size of two, so if your lot size is 2, and you are that is a standard lot size of 2. So standard lot size is you are using a whole number as your lot size. So if you are using a standard lot size of 2, what you are telling the system is that one pip movement you should make $20. So if the market price is 5,000, let's say you are trading gold, and gold is making the market price of gold is 5,000.123, and the market moves from 5,000.123 to 124. Then it means that, then if your lot size is 2, then it means that that one pip movement, you are making how much? $20. Okay, with your $20. So one pip movement, you make what? $20. So you use standard lot size. It's approximately to what? One pip equals 20 USD. So just a pip movement, you make 20 USD out of that. Okay, so that is how it works. So the next lot size I want to talk about is a mini lot size. So if you are using a mini lot size, what you are telling the system is that um, one mini lot size, which is a lot size between 0.1 to 0.9, is a mini lot size. 0.1 to 0.9, any lot size between that. So 0.0, sorry, 0.1, 0.2, 0.3, 0.4, 0.5, 0.9. All these are mini lot sizes. So once you are using any of these things, what does you attend the system is that one um, mini lot size is approximately proportional to you you to one pip movement you make one USD. One pip movement is equal to one USD. That is in a mini lot size. So using 0.0 sorry 0.1 in any lot size between 0.1 to 0.9, then you going to make any pip movement, one pip movement, you make one USD. One pip movement, you make one USD. So as simple as it is. So that's how mini lot size is. Then we have the last one, which is the micro lot size. So micro lot size is actually a lot size between 0.01, 0.01 to 0. To 0. What 09. So any lot size between 0.01 to 0.09 is what? A micro lot size. So usually if you have an account size of 100 USD, 200 USD, 300 USD, you can use a micro lot size. A micro lot size, what you are saying is that one pip movement, you should make 0.1 USD. So one pip movement, you make what? 0.1 USD. One pip movement, you make 0.1 USD. So that is lot size. So your lot size is determined by your account size and your risks, the risks that you want to take per trade. Then when you say leverage, leverage is what do you call it? It's a money that your broker borrows you. So if you have a very small account, if you have a very small account, um, and you cannot trade certain currency pairs with a very small account. So because of that, your broker will want to lend you certain amount so that it will maximize your account size. But that amount you cannot lose it. You can only lose the amount that you've deposited. So the leverage is maximizing, expanding your trading capacity. It's expanding um your trading. But then don't forget that that is the money your the broker is lending to you. But you decide how much you want from the broker. That's why we have 1:2, 1:20, 1:100, 1:500, 1:1000, and all that. So depend if you choose a leverage of 1:20, what you are saying is that the amount that you deposited is, let's say you deposited $10 and you are using a leverage of 1:20, meaning that the amount that you deposited times 20 in the system. So it will be multiplied by what? 20 in the system. Do you understand? But you can only lose the amount that you deposited. You can only lose the amount that you deposited. So you have to be watchful of bigger leverages. The bigger the leverage, the more riskier it becomes because you know you are taking huge amount to trade with a very small account. And then a little pip movement against you can hit your account so hard. So I always recommend that don't use huge leverages. No, don't use huge leverage. Leverage will help you to maximize your account size, but too much leverage can also affect your trading. So maximum 100 or 50 leverage is okay. So you have, let's say, 100 USD account. Use maximum 50 leverage. It's okay. It's okay. 30 leverage. It's okay. And it will help you to trade without any stress. Please, any other question? Any other question? So if you have any other questions, you can ask, and then I will explain to you. You can ask your questions and then I will explain to you. Miss Eugene, do please, you decide to join the live. So this is not compulsory. We are teaching those that are willing to learn. So if you are not here to learn, just scroll up and pass by. Okay, any other questions, guys? Mr. Chris, any other questions about lot size and leverages? Any lot size about lot size? Any question about lot size and leverage? Thank you very much. We are learning. So if you think that you've learned Forex and it did not help you, it does not mean that Forex is not good. That is the problem of those that start trading. You don't have knowledge about trading. Immediately you deposit money and you blow your account. Then you start blaming the whole market. So this guy is an example. Eugene Duke is one of the example of those people. If here we are learning. If you are not interested, you just pass by. Nobody asks you to join. If you've traded and you've not been successful, it does not mean that um nobody can be successful with trading. Your discipline level will determine. So if you are indisciplined, you don't gain much knowledge about trading, and you just watch one or two videos, you think you know everything, you start immediately, you start depositing money, you start trading. Bet me you will blow your account. That is why some of us, we are always hating on people. Someone, when we started, we blew account. So it's not as easy as people think. That's why you must invest in knowledge first. Invest in knowledge. Always demo trade.